Welcome to Market Clown Daily, the world's most chaotic daily show, where markets, politics, and power collide under one big red nose. Hosted by McFoolio, the philosopher clown of capitalism. Each day, I juggle the madness of money, the theater of politics, and the conspiracies that grease the global machine. Also, you can laugh and learn before the next crash. Because
This whole AI build-out seems to flip the script on how industries normally get built.
It absolutely does. Think about a mature industry, cars, electronics, whatever.
Okay.
How does that usually work? The end consumer, the person buying the car or the phone, they're the starting point for the money.
Right. You buy it, the cash flows back up the chain. Retailer, assembler, parts supplier.
Exactly. The whole system is built on actual realized demand from customers. They ultimately carry the risk.
Simple enough. Makes sense.
Mm.
But AI right now, totally different story.
Complete opposite. The end consumer isn't really paying yet, not at the scale needed. Instead, the supply chain itself is underwriting its own massive expansion.
So the companies making the chips, providing the cloud services, they're funding this build-out.
Yes, based on the hope, the assumption that paying customers will show up later to fill these enormous data centers they're building right now.
Which means the capacity they're building. It's
Yeah.
way, way bigger than current proven demand.
Ghastly outstrips it, yeah.
That just sounds Okay, I see that.
Or maybe a better comparison, the telecom bubble. Late 90s, early 2000s, billions poured into laying fiber optic cable.
The dark fiber.
Right. Miles and miles of it, long before anyone actually needed that much bandwidth.
So, okay, history rhymes, but what makes this AI boom different? Because it feels different.
Two things, really. First, the sheer scale is just astronomical. We'll get into the numbers later, but they're staggering.
In second.
The players doing the initial funding, telecom was more debt, newer companies. Here, the first wave of risk-taking. It was the biggest, richest corporations on the planet.
Which brings us neatly to 2024, what we're calling the risk absorption phase.
Yeah.
Last year, it felt like big tech, Microsoft, Google, Meta, Amazon, they just stepped up.
They did. They acted as the collective risk absorbers for the whole ecosystem.
Why? Why take on that massive risk?
Well, it boils down to competition, survival, almost. The cloud market, you see, it's huge, maybe $250 billion a year, an enormous prize. And these hyperscalers saw AI as the next battleground, maybe a winner-take-all situation for that market. So they had to put money in. CapEx escalation became the name of the game.
They were subsidizing everything. Land, power, generators, even helping chip fabs expand.
Pretty much. Regardless of whether they had immediate customers for all that capacity, it was like paying a massive insurance premium.
An insurance premium against becoming obsolete. They were grabbing that hot potato, taking the demand risk, trying to win this supply chain tug of war.
Exactly right. And for companies worth trillions, maybe it was rational. Overbuilding as a defensive strategy.
How so?
Well, if they didn't lock down the land, the power contracts, the physical stuff now, a competitor might. And that could permanently limit their ability to scale later.
So grab the resources while you can.
Yeah. Physical constraints became real very quickly.
But that kind of pressure, that level of spending,
Yeah.
it couldn't last forever, right? Someone had to blink.
And that leads us to 2025. The hot potato shift. This is where the narrative really changes. Big tech started showing signs of, well, caution.
The first domino.
It was subtle but significant. Microsoft, early in the year, walked away from a couple of big data center leases they had planned.
Ooh, okay. That sends a message.
A huge message. Microsoft, arguably leading the AI charge in many ways, basically signaled, hold on, we're not going to just keep writing blank checks for the entire ecosystem's build-out anymore.
We're done being the default risk absorber.
Precisely. The market noticed immediately. It felt like a shift towards matching spending more closely to confirmed demand, not just building speculatively for everyone.
And Amazon.
Amazon seemed to follow, maybe more quietly. Investors started talking about Amazon being underweight on GPU purchases compared to the size of AWS.
Not because they couldn't afford it.
No, it was seen as a conscious choice, a more limited appetite for that pure demand risk compared to Microsoft or Google.
And the fascinating part is, the market actually punished them for it, right? Mm-hmm. Stock sentiment dipped because they were seen as underinvesting in AI.
Yeah, it confirms the market dynamic. Right now, speed and commitment are valued over caution. It's peak FOMO, fear of missing out.
It's not about fear of failure. It's fear of being left off the next big PowerPoint slide about AI leadership.
That sums it up pretty well. But the moment those giants, the ones with the deepest pockets, hesitated.
That demand risk hot potato didn't just disappear.
Nope. It had to land somewhere else, and that created a vacuum.
A vacuum that other players were very eager to fill. Okay, so Microsoft and Amazon take a little step back from just soaking up all the risk. A vacuum opens. Who jumped in?
This is where the neoclouds really came into the spotlight. Companies like Oracle, CoreWeave, Nebius.
The ones building specialized cloud infrastructure just for AI compute.
Exactly. They stepped right up. Suddenly, they were the darlings. Valuations soared, capital flowed their way, capital that maybe would have gone straight to the big hyperscalers before.
But hang on. These companies, Oracle aside maybe, they're much smaller than the Microsofts and Googles of the world.
Significantly smaller, yeah.
They can raise big VC rounds, sure, but can they really absorb the same kind of massive, long-term infrastructure risk? We're talking multi-gigawatt bets spanning decades.
Right, that's the crucial point. They can't. Not really. Their balance sheets just aren't built for that level of unproven long-term demand risk. The math doesn't work on its own.
So, if they can't carry the risk,
Yeah.
and the hyperscalers are pulling back a bit,
It made it basically inevitable that the ultimate suppliers, the chip companies themselves, would have to step in and absorb some of that risk.
okay. So the hot potato gets passed again. Now it's landing with the vendors. NVIDIA, AMD, Broadcom.
That's the critical shift. The demand risk that used to sit primarily with the cloud providers now starts shifting, at least partly, onto their suppliers, the chip makers.
Which is why we're calling them circular deals.
Yeah.
Because it's like
Huh.
the vendor is financing the customer to buy the vendor's own product.
It's the ultimate feedback loop. Think about it. NVIDIA needs to sell its chips, keep the fabs running, book the revenue.
Right.
The neocloud, like CoreWeave, needs NVIDIA's chips to build their data center, but they also need the capital to buy those chips and build the infrastructure.
And traditional lenders, banks,
Yeah.
they're not keen on this.
Not on the unsecured demand risk part. They look at a 15-year loan for a data center based purely on the hope of future AI demand and say, no thanks. Too speculative.
So the only way to bridge that gap is for the vendor, the chip company, to become the financier in some way.
Exactly. Which leads to these very specific intertwined deal structures we started seeing in 2025.
Right. Let's break those down. There were 4 big examples that really highlighted this.
Okay. First, you had NVIDIA's investment in OpenAI, announced as a $10 billion investment.
Tied directly to building out new data center capacity.
Yeah, linked to 1 gigawatt initially, with talk of potentially up to 10 gigawatts down the line. It's NVIDIA putting capital directly into a major customer to accelerate the build-out needed.
Needed to consume more NVIDIA chips.
Precisely. And critically, that $10 million from NVIDIA helps OpenAI avoid having to go out and raise that same amount in a potentially difficult equity round right away. It's targeted, maybe even subsidized capital.
Okay, that makes sense. What's next?
Then you had AMD's deal with OpenAI, also huge. A 6 gigawatt capacity deal announced.
And the payment wasn't just cash, right? This one was interesting.
Right. A big part of the deal involved AMD getting warrants for up to 10% equity in OpenAI.
Okay, pause there. For people listening, what's a warrant exactly? And what does it mean that it was tied to technical milestones?
Sure. A warrant is basically like a long-term stock option. It gives AMD the right to buy OpenAI stock at a set price, probably a very low price, in the future. It can be extremely valuable if OpenAI takes off.
So AMD isn't just getting paid for chips. They're taking a stake in OpenAI's future success.
Exactly. It transforms the deal from just selling hardware to betting on the outcome. We believe you'll build something amazing with our chips, and we want a piece of that upside.
Like getting a slice of the AGI pie they hope OpenAI cooks up.
That's a good way to put it. And the technical milestones are like a safety net for AMD.
How so?
They might be tied to things like OpenAI successfully deploying the AMD chips at scale, hitting certain performance targets, reaching specific cluster sizes. If OpenAI doesn't meet those technical goals needed to actually use the chips effectively, AMD might not get the full value of the warrants. It offers some protection while still getting the chips sold now.
Got it. So it aligns incentives, but with conditions. What else?
We also saw Broadcom get in the game, announcing big capacity deals tied to around 10 gigawatts of infrastructure. Shows it wasn't just NVIDIA and AMD, it's becoming an industry standard structure.
Okay. And the 4th example, you said it was maybe the most revealing.
Yeah, perhaps less splashy, but really telling. NVIDIA backstopping CoreWeave's demands.
Backstopping demand. What does that mean?
It means NVIDIA essentially gave a guarantee, likely to CoreWeave's other investors. They basically said, look, if CoreWeave builds this data center full of our chips and struggles to find enough paying customers to fill it, we, NVIDIA, will step in and buy that unused compute capacity ourselves.
Wow. Okay, that is direct. That's literally the vendor promising to be the customer of last resort for its own customer.
Textbook definition of risk transfer. It's vendor financing, but instead of just a discount, it's a guaranteed demand floor.
So the simple way to look at all these deals, the chip companies are basically subsidizing their customers, lowering the effective price to juice demand.
That's the simplest view, yeah. They're priming the pump, not just with chips, but with capital and guarantees.
Why? Just to move silicon.
Partly, yes. But it also serves another purpose. It signals to the rest of the market, to other investors, that these neoclouds are viable, that development can happen outside the giant hyperscalers.
Which, in turn, helps the neoclouds raise even more external capital. It greases the wheels for the whole ecosystem.
Exactly. It keeps the whole machine running.
Now, you mentioned something crucial earlier, how this is financed. People hear bubble and think debt, like 2008. But that's wrong here.
Fundamentally wrong. And it's the critical distinction. These circular deals, this massive build-out, it is overwhelmingly not debt-financed in the traditional sense.
Why not? Seems like infrastructure projects usually involve a lot of debt.
Because traditional debt investors, the banks, the bond markets, they look at the underlying risk, that 15-year bet on pure AI demand, and they get nervous. Very nervous.
They're unwilling to bet on data center demand in 15 years with unsecured loans.
Precisely. They need a much clearer guarantee that someone creditworthy will pay the bills. The neoclouds, on their own, often don't have that rock-solid credit rating for such massive speculative projects.
So if the neoclouds aren't creditworthy enough for the debt markets, someone else with a bulletproof balance sheet has to underwrite the risk.
Right. You need a player with deep pockets, a low cost of capital, maybe even a negative cost of capital, effectively.
Initially, that was the hyperscalers, like Microsoft backing CoreWeave early on.
But now, increasingly, it's the chip manufacturers themselves. NVIDIA, AMD, they have enormous cash reserves from the boom.
And they get an immediate benefit, right? Even if the investment is long-term risky.
That's key. When NVIDIA invests in OpenAI or backstops CoreWeave, they get to book the revenue for the chips they sell now. It looks great on their quarterly earnings.
Even if the ultimate payoff for that investment depends on OpenAI's success years down the line.
Exactly. They book immediate profit, while the risk associated with their customers' long-term success is deferred. It's a structure that, at least in the short term, maximizes their current results while pushing the demand risk further out.
So the capital has to come from the biggest pools available, which right now means the equity and cash sitting on the balance sheets of these chip giants.
That's where the money is. It's an equity-fueled boom, not a debt-fueled one. #3. The scale and financial ambiguity of the build-out.
Okay, understanding these deals is one thing, but the industry has made it kind of tricky to even grasp the scale of what's being built. They've shifted the language.
Yeah, you hear less about dollars invested now, and much more about GW, or gigawatts of power capacity being built.
Gigawatts, it sounds impressive, very sci-fi. Data centers as the new cathedrals, praying to the EBITDA gods in their Patagonia vests.
Oh.
Is it just spin, making the numbers sound bigger?
There's probably some of that, sure, but it also reflects a very real physical truth.
Which is?
That power is the new bottleneck. Seriously. Finding, securing, and delivering reliable electricity at the scale AI needs is becoming the primary constraint, maybe even more than money or the chips themselves. The GW metric highlights that physical reality.
Can you help us visualize what a gigawatt actually means? Like in terms of physical data centers?
Sure. So think about a really big, modern cloud data center before this AI craze. A typical large one might use, say, 50 megawatts, 50 milliJB.
Right.
A gigawatt is 1,000 megawatts. So 1 GW of AI capacity is like packing the power demand of 20 of those massive traditional data centers into one area.
20, wow.
Yeah, the power density needed for these AI training clusters, with tens or hundreds of thousands of GPUs running flat out, is just orders of magnitude higher than what we needed for traditional cloud computing.
So when we hear figures like 10 GW or even 100 GW.
We're talking about a demand for energy infrastructure on a scale that usually only happens during like wartime mobilization or national electrification projects. It's a civilization level energy shift.
Okay, but talking in GW while reflecting the power constraint does kind of hide the price tag.
Yeah.
We need to convert that back to dollars to feel the financial weight.
Let's do that. Using fairly conservative industry estimates right now, building out 1 gigawatt of AI data center capacity costs around $40 billion.
$40 billion for 1 gigawatt. And that includes everything: land, power hookups, cooling, buildings, the chips, the networking.
Yeah, that's the rough all-in cost today. And it gets worse. The chip companies themselves are already signaling that for the next generation of even more powerful, power-hungry chips, things like NVIDIA's rumored Vera Rubin platform that costs per GW could easily climb to $50 billion, maybe even $60 billion.
Okay, let's stick with the $40 billion for now, just to keep it conservative. The forecasts for total capacity needed through 2030 are, well, they're huge.
They are genuinely hard to wrap your head around. The sort of base case forecast you see analysts talking about is needing 100 GW of AI capacity by 2030.
100 GW times $40 billion per GW.
That's AI's $4 trillion question, just in infrastructure costs. And if the cost per GW goes up like they expect, maybe it's closer to $6 trillion.
$4 to $6 trillion, that's the base case. What about the bull case, the one the market seems to be pricing in?
The really optimistic or maybe aggressive forecasts, they're talking about needing 250 GW of AI capacity by 2030.
Okay, 250 times $40 billion is $10 trillion.
$10 trillion. And potentially $15 trillion if the cost per GW hits $60 billion.
$10 to $15 trillion
Yay.
in less than a decade on just AI data centers.
It's a level of capital expenditure that's almost unprecedented outside of, global conflicts or the Industrial Revolution itself.
But committing the money, building the infrastructure,
Yeah.
that's only half the equation, right? The real ambiguity, the massive financial question mark, is whether anyone will actually generate enough revenue using this infrastructure to pay back that investment.
That is the absolute heart of the risk. It brings us back to that critical revenue question.
Back in 2024, there was that analysis.
Yeah.
What was the number then?
The consensus estimate back then was for every, say, $300 billion invested in building data centers, the users of that compute, the neoclouds, the hyperscalers selling the AI services, would need to generate about $600 billion in total lifetime revenue from their customers just to break even.
Assuming about a 50% gross margin on those AI services.
Right, which is pretty standard for high-end cloud stuff, so a 2x revenue multiple on the CapEx.
But we just established the CapEx numbers have exploded, the cost per GW is rising.
Right.
So what's the required revenue number now for 2025 and beyond?
Based on the updated scale and cost, the latest analysis suggests that required lifetime revenue number has ballooned significantly. We're now looking at needing roughly $840 billion in end-user revenue to justify the current and projected spending levels.
$840 billion. That's a staggering amount of money that needs to come from somewhere.
It is, and it's largely unconfirmed speculative revenue at this point.
We know the first customer, the neocloud, buying the chips, they must be financially viable enough for NVIDIA or AMD to do these circular deals.
Right. The vendor wouldn't invest otherwise.
But the really critical, unanswered question is the customer's customer healthy enough? The startup using the API, the enterprise deploying the AI model, can they generate the $840 billion in actual value and revenue to make this whole gigantic system solvent in the long run?
That's the entire game. That's the financial tug-of-war. As long as that final end-user demand is still foggy, still speculative.
Then everyone higher up the chain has an incentive to push the risk away from themselves.
Exactly. Maximize your own profit now. Minimize your own perceived demand risk now by passing it along through vendor financing, through warrants, whatever structure works.
And as long as the biggest chip makers keep funding their own customers through these deals.
It signals they believe that $840 billion can eventually be found. It becomes this weird, self-fulfilling prophecy driven less by proof and more by competitive necessity and fear. #tag5V. The game theory of CapEx escalation, the arms race. When people look at this insane level of spending, the trillions we're talking about, the conversation often gets framed pretty simply.
Yeah, it's usually the AI bulls versus the AI bears, right?
Yeah.
Are we building too much or not enough?
Exactly. But the analysis we're looking at suggests that's kind of missing the point. It's a distraction.
Okay, so what's the real debate then?
It's not really about the ultimate magnitude of the build-out. It's about the speed, the sheer breakneck acceleration of spending. That's what's driving the fragility. That's what's fueling this financial craziness.
Speed over magnitude. Why is speed the critical factor?
Well, here's the fascinating part. From a game theory angle, the more you actually believe in AI's massive world-changing potential,
The more bullish you are on the tech itself.
the more you should probably fear the current speed of the infrastructure build-out.
Wait, that sounds backwards. If you believe in AI, shouldn't you want to build faster?
You'd think so, but the fear is that AI model progress itself will outpace the physical infrastructure we're locking in today.
The obsolescence risk. We build these giant billion-dollar barns full of today's chips.
Exactly, full of H100s, B100s, and then boom, a breakthrough in model efficiency, or the next generation chip arrives sooner than expected, and suddenly all that incredibly expensive hardware is legacy tech.
We've heard people say, starkly, no one will train a frontier model on the same data center twice.
It's almost true. By the time a huge model finishes its training run, the cutting edge has often moved on. You need bigger clusters, maybe 100,000 GPUs instead of 50,000. You need different power and cooling setups.
So every dollar spent on CapEx today is locking in assumptions about technology that might be wrong tomorrow.
Right. It creates this immense pressure to use the infrastructure now, get your money's worth before it becomes outdated, which just feeds the frenzy.
So if building this fast is fundamentally risky from a technology obsolescence perspective, why the insane rush? Why is everyone doing it?
This is where you get into the AI arms race. Forget missiles. Now it's about who can burn the most electricity pretending to be God.
Huh. So it's not just optimism driving this.
Not primarily, no. The core driver is ruthless oligopoly competition. It's fear.
Fear among the giants. Microsoft, Amazon, Google.
Yes.
Huh.
They're fighting for dominance in that $250 billion cloud market. They see AI as the key battleground, potentially zero-sum, so it becomes pure game theory.
Microsoft spends more, so Amazon feels forced to spend more, which makes Google spend more.
And round it goes. It's completely self-reinforcing. These companies are collectively worth, what, over $7 trillion? When they get into a competitive spending spiral, the numbers become astronomical.
It's like a multi-trillion-dollar game of chicken. Or maybe a billionaire's midlife crisis played out with data centers instead of sports cars.
Yeah.
They just can't stand being left out.
There's definitely an element of that. And they can justify it internally by saying, look, our balance sheets are huge. We can afford a massive write-off if we're wrong about the timing.
But we absolutely cannot afford to miss the boat on AGI if we're right.
Exactly. Which makes overbuilding seem like a rational defense motivation.
How is overbuilding defensive?
It raises the barrier to entry. The sheer cost and complexity of building AI infrastructure at this scale means only companies with incredibly deep pockets, companies that can stomach potential multi-billion-dollar write-downs, can even play the game. It locks out smaller competitors.
Okay, so there's the financial game theory. But you mentioned physical reality too, the physical constraint.
Yeah, this is where the abstract idea of AI slams into the real world of atoms, not just bits, and it translates directly into GDP through this massive construction boom.
Because you need actual stuff.
Yeah.
Steel, concrete, wires.
And critically, land and power. If you don't grab the prime locations with available grid connections now, if you don't secure the long lead time equipment now, someone else will.
And then you're locked out.
Potentially. We heard specific examples in the sources that are pretty alarming, like the specialized, massive diesel generators needed for backup power at these huge facilities. The order books are full, sold out until 2030.
Wow. Sold out for years. If you can't even get backup generators until 2030, that tells you how strained the physical supply chain is.
It really does. It's not just a software problem anymore. It's a hardcore infrastructure and manufacturing bottleneck. People were thinking about AI in terms of bits, algorithms.
They should have been thinking atoms, construction, power grids.
Precisely. And this construction boom itself is now a noticeable part of U.S. GDP growth, all driven by this speculative arms race dynamic. We've swapped nuclear deterrence for GPU deterrence. If I can't train AGI first, I'll make damn sure nobody else can either by cornering the resources.
And all this physical building creates another, maybe underappreciated, competitive advantage.
Absolutely. What we could call the construction moat.
Meaning, just the ability to build these things is hard.
Incredibly hard. At this scale, at this speed, simultaneously with everyone else trying to do the same thing, it's a nightmare of complexity.
You need specialized expertise. You have to navigate power utility regulations, environmental reviews.
You're competing for the same limited pool of contractors, electricians, specialized equipment vendors. It compounds. The companies that actually get good at the logistics, the project management, the physical execution of building these AI factories, they'll have a real durable advantage.
So the physical challenge of laying the foundation for AI is proving almost as daunting as the financial gymnastics needed to pay for it all.
They're deeply intertwined. #V. Financial fragility and the nature of the bubble unwind.
So we've seen the risk hot potato get passed around,
Uh-huh.
ending up with smaller neoclouds and even the chip makers themselves through these circular deals.
Right. And that whole dynamic, that visible shifting of risk onto potentially less stable players, reliant on vendor financing. That's a big reason why the AI bubble talk went from being kind of a contrarian take a year ago to pretty much the consensus view today.
The fragility is just more visible now. The system feels like it's relying on the continued goodwill or maybe the competitive desperation of the big chip providers.
That's a good way to put it. The financial fragility is palpable.
And it seems like that financial tension is mirrored by a kind of psychological fragility, too. We have to talk about the talent situation.
Right.
The compensation packages are just astronomical.
Oh man, yeah. That part is genuinely shocking. It speaks volumes about the sheer intensity, maybe desperation driving this arms race. The pay scales are unlike anything we've seen.
Like what? Give us some examples.
Okay, you've got reports of, say, a 25-year-old fresh out of a PhD program, maybe with some perceived edge in a specific AI technique. They can command a total comp package worth $50 million.
$50 million. For a recent grad, is that mostly stock options?
Mostly equity, yeah, tied up in the potential future value, but still, $50 million. And then you have the established stars, the big brand name AI researchers.
The ones with published papers, conference keynotes?
Right. For those individuals, companies are apparently writing packages worth $1 billion.
$1 billion. For one person. How is that even structured? Cash, stock.
Seems to be a mix. Significant cash, huge stock grants, maybe research budgets bundled in, but the headline number is hitting $1 billion for top-tier, highly coveted talent.
Is there any rational justification for that? How does the CEO sign off on $1 billion package for one researcher?
The justification they use, at least on paper, is basically venture capital math scaled up to an absurd degree.
Meaning?
The argument goes something like this. Our company aims to be worth trillions thanks to AI. If hiring this one specific genius increases our probability of achieving that trillion-dollar outcome by just, say, 1%,
Right.
then their contribution is theoretically worth 1% of a trillion, which is $10 billion. So a $1 billion package is a bargain. That's the napkin math they use. Technically, it works out.
But it feels flimsy.
Because it probably is. The human brain, especially in a FOMO-driven frenzy, is terrible at accurately judging those tiny percentage contributions. We tend to overestimate the impact of a single hero researcher and underestimate how much progress comes from broader trends, shared knowledge, and just grinding engineering work by thousands.
So the insane pay is really a symptom of the underlying pressure.
I think so. It's like we're betting the farm on this multi-trillion-dollar infrastructure build-out. We have to believe that acquiring the perceived best talent at any cost validates that bet and gives us an edge. It's channeling the financial desperation into a talent war.
Okay, so we have this fragile system fueled by circular deals and potentially irrational talent spending. It inevitably makes you ask, how does this correct? How does the bubble, if it is one, unwind?
Right. And the immediate mental anchor for most people when they hear bubble unwind is the 2008 financial crisis, debt, banks collapsing.
But you said earlier that anchor is wrong here.
Why? Because unlike the 2008 housing market, which was drowning in complex debt instruments, this AI build-out is primarily equity and cash funded. Remember, it's the hyperscalers using their profits and the chip giants using their cash reserves and stock.
So if it corrects, it won't be mainly a debt crisis.
No, it'll be an equity unwind.
Okay, what's the difference? What are the implications of an equity unwind versus a debt crisis?
2008 was about the plumbing of the financial system seizing up. Banks couldn't trust each other, credit froze. The immediate pain was concentrated in the financial sector, though it spread outwards.
But equity unwind is different how?
An equity unwind means stock prices fall, potentially very sharply, very quickly. And because of who is driving this AI boom, the impact hits differently.
You mean the Mag 7, the tech giants?
Exactly. These handful of companies, Microsoft, Apple, NVIDIA, Google, Amazon, Meta, Tesla, they make up an unprecedented chunk of the overall stock market.
What kind of percentage are we talking about?
Right now, the Mag 7 represents something like 40% of the entire S&P 500 index by market capitalization. 40%.
That's huge concentration.
It is, and more Americans than ever before have their savings, their retirement funds, tied up in the stock market, often passively through index funds that heavily weight these exact companies.
So if these specific stocks take a major hit because the AI timeline gets pushed out, or the spending proves excessive,
the impact on average people's net worth is much more direct and widespread than the 2008 crisis initially was. It wouldn't just be Wall Street feeling the pain. It would ripple through almost every 401k, every pension fund, much more immediately. A broader, more direct hit to household wealth.
So the core risk isn't necessarily that AI fails completely as a technology. It's more subtle than that.
Yes. The real danger is the timeline risk. The mismatch between the market's expectations and the actual pace of scientific and engineering progress.
We're spending trillions now building these H100 and B100 data centers based on an...
That seems to be the implied financial timeline, yes. But what happens if the real breakthroughs, the ones needing the next generation of chips, the Feynman or Rubin chips, people speculate about, what if those actually take 10 years to arrive in scale?
If the real AGI payoff is a decade away, not 2 years away.
Then all this multi-trillion-dollar capex we're pouring in today risks becoming warehouses full of expensive, rapidly depreciating legacy silicon before it ever generates the expected return.
Expensive space heaters, as someone cynically put it.
Pretty much. And the irony is often the people who actually invented the core AI technologies, the deep learning pioneers, the reinforcement learning experts.
People like Andrej Karpathy, Richard Sutton.
Exactly. They are also the ones cautioning that true AGI, or even broadly transformative economic impact, might still be a decade, maybe 2 decades away, not a short sprint.
So you have this profound disconnect. The measured longer timelines from the scientists versus the frenetic, compressed 2-year timeline demanded by the financial markets pouring in the trillions.
That disconnect is the defining fragility of this whole moment. The market is making a multi-trillion-dollar bet on a delivery schedule that the technology's own creators often suggest is unrealistic. That's where the potential for a painful unwind comes from.
Okay, given all this fragility, the timeline risk, the potential for an equity unwind, we need a way to think about who actually navigates this successfully. If the market corrects, who wins and who loses.
The core framework that comes out of the analysis is pretty clear, and it revolves around one key question. Is a company fundamentally a consumer of compute or a producer of compute?
Consumer versus producer. Why is that the critical dividing line?
Because it determines how you experience a potential oversupply. If you're producing a commodity, and let's face it, raw compute power is becoming a commodity, you're vulnerable in an oversupply situation. If you're consuming that commodity, an oversupply is fantastic news for you.
Okay, let's unpack that. First, the winners. Consumers of compute win. Why does overbuilding help them?
It's basic economics, really. If this whole arms race leads to a massive overcapacity of AI compute infrastructure,
Which seems likely, given the dynamics we discussed.
then the price of using that compute has to eventually fall. Competition will drive it down.
So if you're a startup building an AI application or a big company using AI services,
Your main input cost, your cost of goods sold, COGS for the AI part, goes down, maybe dramatically. Your raw material compute cycles, API calls, gets cheaper and more plentiful.
which means your gross margins go up.
Exactly. You consume the relatively raw resources, the chips, the power, the infrastructure built by others, and you add value on top. Building intelligence, applications, user experiences, you benefit from the commoditization below you.
So in a weird way, this multi-trillion-dollar CapEx frenzy by the chip makers and the cloud providers, it's effectively a giant subsidy for anyone building on top of them.
That's a perfect way to frame it. The intense competition among the producers guarantees, at least for a while, lower prices and more accessible compute for the consumers. It spurs innovation at the application layer, even if the underlying infrastructure investments themselves struggle to be profitable before they become obsolete.
Okay, so consumers benefit from the potential glut. Conversely, producers of compute struggle.
They face a much tougher road, especially if overcapacity becomes the norm. They're fundamentally in a commodity business.
Like oil companies or miners.
Very similar dynamics. If everyone is producing essentially the same thing, petaflops of compute, it becomes incredibly hard to differentiate and maintain pricing power. Your fancy, super efficient data center might be slightly better than the next guy's, but you're both selling the same core product.
And commodity businesses tend to be.
Cyclical. Brutally competitive. They operate on thinner margins, their stocks often trade at lower multiples. As a producer, you're constantly fighting price pressure, trying to optimize costs, and your destiny is often dictated by these large global capex cycles that are somewhat out of your control.
It's a harder way to make a living long term.
Definitely less predictable, less controllable.
This producer-consumer framework makes me wonder about monopolies. We live in an era dominated by the tech monopolies, the Mag 7. Why wouldn't AI just follow that same path? Won't one or two companies just end up controlling all the compute? That's the monopoly myth in AI.
It's a really important question, and the reason AI might be different comes down to how those original tech monopolies were formed.
How so?
Think about Google Search, or Amazon Web Services, or Facebook's social graph. When they were starting, they were kind of hiding in plain sight.
Gaming.
Nobody, not even themselves initially, fully grasped how massive those opportunities would become. Cloud computing, selling enterprise server capacity as a utility. In the early 2000s, that seemed niche. Mobile advertising based on search, also not obvious.
They built their dominance in relatively low competition environments because the scale of the prize wasn't clear yet.
Exactly. They scaled up while everyone else was looking elsewhere. But AI is the complete opposite. The defining irony of the AI era is that everybody knows, or at least believes, that it's going to be unimaginably huge, transformative, and valuable. There's no hiding in plain sight this time.
Because everyone sees the potential multi-trillion-dollar prize.
Everyone jumps in. From
Yeah.
tiny startups in garages to the $3 trillion behemoths, the result is just ferocious, immediate global competition from day one.
And that level of intense competition makes it much harder for any single player to achieve the kind of near monopoly profits the earlier tech giants did in their core businesses.
Highly unlikely, I'd say, which, as you pointed out earlier, is probably a good thing for society and for end consumers. More competition means lower prices, faster innovation. We get the benefits closer to the actual cost of capital.
Okay, that makes sense.
Mm.
But it leads to a final fascinating paradox. If the consensus, especially in venture capital, is that the consumers of compute are the better long-term businesses, why are we still seeing this massive capital flow paradox
Yeah.
where most of the money is still pouring into the producers?
It is a striking paradox, isn't it? You talk to VCs, read the analyses, and the smart money seems to agree. The application layer, the companies consuming compute to build valuable services, that's where the sustainable margins and better business models likely reside.
But the investment dollars aren't following that logic.
Not predominantly. Estimates suggest that probably 80%, maybe even more, of the capital flooding into the AI space right now is still going to the producers, the chip makers, the neoclouds building the raw infrastructure, the funds financing the data centers.
Why? If the long-term business model is seen as tougher, more commoditized, why does the money keep flowing there?
It really boils down to a simple, almost mechanical issue: capital deployment requirement.
Meaning the funds are just too big.
Pretty much. Think about it. If you're managing a multi-billion-dollar venture fund or a massive sovereign wealth fund or a corporate venture arm, you need to deploy huge amounts of capital to move the needle.
And building a single multi-gigawatt data center costs tens of billions of dollars.
Exactly. The producers of compute, the infrastructure builders, are basically the only players in the ecosystem who can absorb those enormous check sizes. A startup building an AI application might need $50 million, maybe $100 million. NVIDIA or CoreWeave can absorb billions in a single round or deal.
So the capital flows where it can be deployed at scale, even if the underlying business isn't necessarily the most attractive long-term bet.
That seems to be the dynamic. The need to deploy maximum capital is overriding the strategic assessment of the best business models. It's a kind of failure of the investment mandate, where sheer volume trumps fundamental business quality. #outro.
Okay, let's try to wrap this up. We've covered a lot of ground in this deep dive on circular deals and the AI build-out. What are the main takeaways?
Well, we've definitely established that the financing behind this AI boom is, let's call it unconventional, this strange loop where risk gets passed around.
Yeah, the big hyperscalers got a bit cautious, passed the hot potato to the smaller neoclouds.
Which then forced the chip giants, NVIDIA, AMD, Broadcom, to step in with these circular deals, basically becoming financiers and guarantors for their own customers.
All to keep the CapEx machine churning, often without clear, confirmed demand from the ultimate end user. They're booking revenue now, selling hope on credit for later. It's corporate incest with a tax deduction, maybe.
It's certainly maximizing immediate results while deferring the big risks. And this whole frenzy, this arms race, it's not just financial game theory. It's hitting real-world physical constraints: power, land, construction capacity.
Pushing CapEx into the trillions. But, as we discussed, that massive spending does have a side effect. It's a huge subsidy for anyone building AI applications.
Absolutely. It guarantees lower compute costs, at least for a while, which is great for innovation at the consumer level.
But the underlying structure feels fragile. It's reliant on equity, not debt, making it vulnerable to a potentially broad equity unwind. It's driven by psychological desperation for talent at insane prices.
And critically, it's all based on this incredibly compressed timeline. A multi-trillion-dollar bet that major breakthroughs will justify the cost within just a few years.
Which brings us back to that core, unanswered $840 billion question. Will the actual end users of AI generate enough value, enough revenue to make this whole system pay off before the infrastructure becomes obsolete? We know the motivation for the build-out is fear and competition.
Not necessarily proven demand. So here's the final thought to leave you with. If the AGA timeline keeps stretching out, as many of the scientists who invented this stuff suggest it will, if it's 10 or 15 years away, not 2,
Yeah.
how long can the world's biggest, richest companies keep doubling down on this uncoordinated, multi-trillion-dollar infrastructure bet based largely on fear and hope? Is there a point where even they're forced to blink, where fiscal reality has to finally outweigh competitive paranoia?
When does the sheer cost force a moment of collective reckoning? That's the dynamic we're watching play out right now.
It certainly is.
A fascinating, if slightly terrifying, picture. Thanks for breaking it down for us.
Always a pleasure. See you next time.
Thanks for joining us for the deep dive.